Every quarter, large institutional investors are required to file something called a 13F filing with the SEC. This is something like a public scorecard, where it reviews exactly what these big players have been buying and selling over the past 3 months. And why does this matter? Because these aren't just any investors. These are the so-called super investors, people who manage portfolios ranging from hundreds of millions of dollars to billions of dollars. One of the most famous super investors that you definitely know is Warren Buffett, but there are also many other notable names such as David Tepper, Michael Burry, and Bill Ackman. These are the people who have built their reputation by consistently beating the markets over decades. To put it in sports terms, it's like watching the best athletes play and seeing what we can learn from it. If Stephen Curry changes his shooting form or Messi develops a new way to approach a free kick, fans and other players will pay close attention. The same goes for investing. When the best in the game makes a move, there's usually something behind it. In this video, we will look at the 5 stocks that super investors are buying right now, who's been buying them, what these companies do, how the stock has been performing, and whether they have strong growth potential ahead. So with that being said, let's start with the first one, UnitedHealth Group. UnitedHealth Group has been one of the largest buys among super investors last quarter. It made headlines when Berkshire Hathaway disclosed they acquired 5 million shares, prompting the stock to surge by 12% in a single day. But it wasn't just Warren Buffett who bought in. Many other prominent fund managers like Christopher Davis, David Tepper, and Michael Burry have also bought in. UnitedHealth isn't just another insurance company, it is also the largest health insurer in the US, covering more than 50 million people in the country alone. But despite its size, 2025 has been a rough year. The company was first hit by reports of a Department of Justice investigation into Medicare billing practices, which rattled investors. Shortly after, rising medical costs forced management to slash its earnings outlook. Then came the leadership turmoil, including a surprise CEO change and then a suspended guidance, which further added to the uncertainty. All this negativity sends the stock tumbling. At its lowest point, the stock was down by nearly 50% year to date. This was a brutal fall for a company that was once considered one of the safest names in healthcare. However, what gives many investors comfort is the company's moat. UnitedHealth isn't just an insurer, it is an ecosystem. Through its Optum division, the company also manages pharmacy benefits, provides data analytics for healthcare systems, and even delivers care directly through clinics and physicians. This level of vertical integration gives UnitedHealth a scale and efficiency advantage that very few competitors can match. Because of that, even though Morningstar classifies UnitedHealth as having only a narrow moat, it still emphasizes that the company possesses enough competitive advantages to generate economic profits for at least the next decade. Because of that, even after rallying 45% off its bottom, I still believe UnitedHealth is undervalued. If I were to use a conservative free cash flow growth rate of 10%, which is well below its historical 10-year growth rate of 15%, the stock's fair value still comes up to around $438. Likewise, analysts from Morningstar also gave it a fair value of $400. This seems to suggest that the stock is still cheap. Looking forward, there are clear structural tailwinds for the company. UnitedHealth expects nearly 78% of its Medicare Advantage members to qualify for the 4-star or higher ratings by 2026. This will unlock billions in potential bonus payments from the government. At the same time, Optum is expanding its footprint in value-based care, shifting away from fee-for-service models and aligning its profits more directly with patient outcomes, a move which is strongly supported by policymakers and payers. Beyond these immediate catalysts, another underappreciated growth driver comes from aging demographics. By 2030, around 1 in 5 Americans will be over the age of 65. That translates into higher demand for Medicare Advantage, more pharmacy spending, and greater need for chronic care management, all areas where UnitedHealth already has a significant head start. Quick pause: with Moomoo's free tools, you can now easily see what super investors have been buying. Just head over to Markets, US, and scroll down to the institutional tracker. Here, you can check out all the moves Buffett's Berkshire Hathaway and many other institutional investors have made. Tap follow, and you will even get notified whenever they update their portfolio. You can also view all of their publicly listed holdings in one place. And if you click into any stock, you will see their past buy and sell actions. For example, with Apple, you will notice that Berkshire has been steadily trimming its stake, which could potentially hint at Buffett's changing views on the company. And it's not just about Berkshire. If you want to see institutional activity for any stock that you are interested in, just head over to the stocks page and tap Company Shareholders. And here, you will find details on both institutional holdings and insider trades. This gives you a clearer picture of who's been buying and selling. New users who sign up to Moomoo SG will get to earn up to $1,120 worth of welcome rewards when you fulfill the terms and conditions. This includes a $20 worth of Nvidia share. Plus, enjoy zero commission for US, Hong Kong and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Next up, we have Amazon. The stock is only up by about 4% year to date, and much of the sluggish performance was due to the challenges the company is currently facing. In Q2, AWS revenue growth slowed to just 17% year over year, well behind Microsoft Azure at 39% and Microsoft Cloud at 32%. At the same time, while consumer demand has so far held up, Amazon has warned that prolonged tariffs on Chinese imports could eventually force price hikes or squeeze margins. On top of that, Amazon is also facing growing regulatory scrutiny, with antitrust and data privacy investigations across the US, EU and UK casting a cloud over its expansion plans. Yet, despite these headwinds, Amazon remains one of the top buys among super investors in the last quarter. One of the biggest moves came from Bill Ackman's Pershing Square, which added Amazon as a 9% position, calling it extremely attractive despite short-term concerns. Besides Ackman, many analysts share that optimism. For example, Wall Street still rates Amazon a strong buy, with average price targets around $260. Morningstar also recently raised its fair value estimates to $245 per share, while reaffirming Amazon's wise mode rating. While my own conservative model of using a 23% earnings per share growth rate puts Amazon fair value at $237. In other words, Amazon doesn't look especially cheap, but it doesn't look expensive either. Personally, I think Amazon's moat is not just wide, but getting wider. Amazon Prime already has over 220 million paying members worldwide. AWS is doubling down on AI with a $100 million generative AI innovation center and billions in new data centers. And robotics are transforming its warehouses to drive long-term efficiency gains. On top of that, Amazon is quietly regaining shares in online grocery delivery, leveraging on its logistic backbone and Whole Foods presence to claw back ground from rivals. When you add it up together, it's not hard to see why many super investors are bullish about the company. The next stock that super investors have been buying into is none other than Google. For the past few quarters, much of the conversation around Google has revolved around antitrust concerns. However, the pivotal moment finally came in September, when a US judge handed Google a landmark win, ruling that it wouldn't need to divest Chrome or Android, though it would need to curb exclusive search deals and share indexing data with competitors. That decision triggered a 13% price surge in Alphabet's shares over the next few days. Despite the rally, Google still appears to be fairly valued. Morningstar assigns it a fair value estimate of around $237 and maintains a wide moat rating, citing the resilience of its search, YouTube and cloud businesses. Other analysts have the same view as well, giving Google an average price target of $239. On my own model, if I assume a 20% earnings per share growth rate, I would also reach a fair value of about $265, which suggests that Google is currently trading at where it should be. Google's moat comes from its dominance in areas that touch billions of people every single day. It controls more than 90% of the global search market, owns YouTube, the largest search engine in the world, and commands nearly 30% of the global digital advertising market. On top of that, it also runs Android, the world's most widely used mobile operating system, and has grown Google Cloud into a $40+ billion business, competing head-to-head with Amazon's AWS and Microsoft Azure. And yet, Google isn't standing still. The company is weaving its Gemini AI model into search, YouTube, Workspace and Android, turning its existing platforms into AI-first products. Beyond that, Google is also investing into self-driving technology with Waymo, quantum computing research, and even healthcare AI applications. Because of that, I personally think Google remains one of the most compelling long-term bets in tech. Moving on, we have Pinduoduo. This company has been catching serious attention from super investors. In fact, Pinduoduo ranks among the top 5 holdings in the portfolios of notable names like Lilu, Norbert Lau, and Duan Yongping. Pinduoduo began as a group buying platform in China, encouraging users to team up to buy products at lower prices. Over time, it expanded into agriculture, branded goods, and electronics, while also building a powerful international presence through its overseas arm, Temu. This has made it one of China's top e-commerce players, competing directly with Alibaba and JD.com. But while Alibaba built its edge around a broad marketplace for established brands and JD.com around logistics and fast delivery, Pinduoduo differentiated itself through social e-commerce and aggressive subsidies, a model now being replicated globally through Temu. In Q2 this year, Pinduoduo revenue grew just 7% year-over-year, narrowly missing expectations as intense competition and higher fulfillment costs weigh down on growth. Meanwhile, margins narrowed due to heavy investments in logistics and subsidies to keep Temu's global expansion on track. Despite all that, super investors are drawn to Pinduoduo's long-term potential. That's because the company recently announced plans to invest more than 100 billion yuan across the next 3 years to upgrade its merchant ecosystem, funding improvements in logistics, seller support, and product quality. While these investments may hurt margins in the short term, they could reinforce Pinduoduo's moat by strengthening merchant loyalty and improving customer experience. In terms of valuation, Morningstar values Pinduoduo at around $123 per share, which puts it in the fair value category. Likewise, analysts give it an average price target of around $153, indicating that there's still more upside to go. But if you ask me, personally, I feel that while there's nothing fundamentally wrong with Pinduoduo's business, the challenge is the fierce competition it faces, both domestically from Alibaba and JD.com and internationally as Temu goes head-to-head with the likes of Amazon. In that kind of environment, even the best execution may not guarantee outsized returns. And for me, they are simply easier stocks to buy with wider and more durable moats, where the long-term payoff feels more certain. Think of Google, which dominates global search with over 90% market share, or Amazon, where Prime membership locks in more than 220 million paying members worldwide. Even UnitedHealth, with its scale in healthcare and Optum's vertical integration, enjoys advantages that are incredibly hard for rivals to replicate. Finally, we have Lululemon. Lululemon isn't just an apparel company, it is a premium brand that built its reputation on yoga pants. Unlike Nike and Adidas, which heavily rely on wholesale partners, Lululemon controls most of its sales through its own stores and websites, which allows it to maintain both margins and brand exclusivity. However, after years of rapid growth, Lululemon is now facing a slowdown in North America as consumers pull back on discretionary spending. At the same time, the company struggled with inventory management, leading to margin pressure. Its shares are down more than 50% year-to-date, making it one of the worst performers among large consumer discretionary stocks. Still, some super investors see opportunity here. Lululemon has been pushing aggressively into international markets, particularly China, which the management expects could eventually become as large as North America for the brand. It is also doubling down on menswear, a category that remains new but has shown strong double-digit growth. Add to that its ongoing expansion into connected fitness and footwear, and the company is positioning itself to be more than just a yoga apparel brand. From a valuation standpoint, the sell-off has actually made Lululemon more attractive. Morningstar currently pegs its fair value at $295 per share. Meanwhile, analysts give it an average target price of $254, indicating that the company is a buy. But if you ask me, I'm not as enthusiastic. And the reason for that is simple. I think Lululemon's moat just isn't very wide. At the end of the day, this is still a consumer apparel company where fashion trends can shift quickly. Lululemon has executed well so far, but there's no guarantee that the edge will last. For all we know, another brand, whether it's Nike, Adidas, or another new upstart, could just come along with the right mix of style and marketing and chip away at its market share. Personally, I would rather own wide moat businesses with little to no real competition, like S&P Global, which dominates credit rating and market data, or Visa and MasterCard, which control the global payments network. These kinds of companies have structural advantages that are incredibly hard to disrupt. And that's why no matter how premium Lululemon feels as a brand or how undervalued the stock might look on paper, I would rather stay away. So, those are the top 5 stocks that super investors are buying into right now. What do you think? Will you buy any of these? Or do you see other opportunities that they might have missed? Let me know down in the comments below. And if you found this video useful, don't forget to like, share and subscribe as I'll be posting new videos every week.